Well, it's a pleasure for me to be with you again today in part two of the Exit Prep Summit. And we're going to talk about getting the timing right relative to a business transition. So again, my name is Scott Mitchell with SDR Ventures. SDR is a lower middle market investment bank exclusively focused on helping founders and entrepreneurs at capital inflection points. So it could be selling a business, preparing to sell a business. It could be raising capital and even buying a business. So, in our ethos at SDR, right, is that the the transition of a business is really a climactic chapter in the story of an entrepreneur. And I don't know if you remember those choose your own adventure books that used to be out there where you'd read a chapter and then you'd have to make a decision, right, about what you're going to do next. And then theoretically you had to live with that decision and then keep going in the book. And so it's one that, if not done right, you could end up in a dark place in one of these choose your own adventure books. And so really, as it relates to timing the transition of your business, it's something that, if not done right, it's caused folks a lot of heartache in what should be a time of flourishing. And so I put these exit readiness stats up here again from the first session, just to remind folks why we're here. And it's really about planning and preparation and doing the things necessary to get that right. So in part one, we talked about maximizing the value of your business as a key lever, in the business transition process. We talked about how grade A assets trade at a significant premium to, a grade B or C asset. And we talked about how your unique moat or your unique differentiators that make your business attractive, how to position those in the eyes of investors. And so in part two, we're going to talk about timing, as I said, and its impact on business value. Timing is really all about runway. For a plane to take off, it needs runway. So to maximize the value of your business, one thing that's true is you need to leave the buyer or investor plenty of runway in your business. And if you're prepared, if you do the right things proactively about timing, then the reality is you can be the one to choose your timing. And the challenge that I often see with business owners is that they're actually reactive to the timing of the transition instead of proactive. They don't think about transitioning the business until they're already maybe they're already tired, right? And they already just want to be done. And so one thing we always say is you'll get a much better deal if you transition the business when you want to and not when you need to, right? So buyers are able to sense, right, if a seller is desperate. And the other thing I often see, and we will chat about toward the end of the session, is that sometimes folks only really think about business transition when a buyer approaches them in an unsolicited way with an offer to strike up a conversation. And so my analogy there is, look, if someone showed up at your door this afternoon and knocked on the door, rang the doorbell, and you opened it, and they stuck a check in your face and said, "Hey, I want to buy your house," right? Is that the moment at which you really want to consider selling your house, right? Or have you done the work beforehand? All right. So if you take away anything from this discussion, it's really just to be intentional about your timing, be strategic, don't wait to plan for your transition until the sands of the hourglass are running out. I often say, do not wait until midnight, okay? You don't want to be running out of the ball with no shoes on and your carriage is turning into a pumpkin, all right? It's better to sell a little bit too early than a little bit too late. I always say, hey, try to sell at 10 p.m., right? If you're trying to time your sale around midnight when everything is exactly perfect, it generally doesn't work out well for folks. And so unfortunately, we actually what we see is a tendency for folks to wait past midnight in a lot of cases, and maybe the business isn't positioned correctly, and maybe the ownership group is past a state of really being intentional in their care for the business. I want to revisit the three pillars and the three-legged stool that we talked about from the first session and answer that. Well, why is it so hard, for business owners to get prepared for that transition, right? Because I do believe that most business owners understand intuitively that planning for their exit is important. I think the challenge is it's rarely urgent. And so the tyranny of the urgent can always cause you to backburner those things that are important, right? I think also they oftentimes just don't know where to start. They feel maybe embarrassed that they don't know what they don't know about that preparation. And so that's the beauty of doing the preparation summit and working through these issues. So the last time we talked about this three-legged stool of a successful business transition, we talked a lot about scalability and what makes a business scalable. And just as important for the founder and entrepreneur is making sure they have a really good understanding of how the impact how the sale of the business is going to impact their personal balance sheet. So I want to touch briefly on just preparing from a personal liquidity perspective. One reason that sellers wait longer than they should to transition the business is they haven't done a really good job of actually figuring out how much money they need in that next phase of life. So owners suddenly consider selling and they haven't thought about how the purchase price or value will actually impact their financial future. Will you have what you need in the next chapter of life? Will you potentially need another income stream, right? If you sell at a certain price. On the other hand, if the business is worth way more than you need, then diversifying your personal risk allocation may actually mean selling sooner. And so, I'm always surprised at how often a business owner hasn't really worked with a wealth advisor, wealth manager, estate planning group to have a real plan on what they need. And again, when an advisor like that is doing a financial plan, I say it's more compass than map, right? It's directional. Planning is the substitution of error for chaos. And so the plan's not going to be 100% right or even 95%, but error is superior to chaos. And that's why we plan, so that you can have directional goalposts about what you need in life. The other thing, that in this vein that people should think about is you want to intentionally build the business to know what is there a goal in terms of that value of the business that's important to you, so that you know that it's at a place where if you sell it, you're going to have what you need in that next phase. So, oftentimes, unfortunately, I see the business never really gets to the owner the value needs, because they're not really building it in an intentional way to achieve a certain value. And they're kind of, hoping against hope that some buyer's going to come along and seriously overpay for their business. That happens on occasion, but that's not really a strategy. That's wishful thinking. On the other hand, right, I also see where the business owner waits and the business is actually worth exceedingly more than they're actually going to need in the next phase of life, right? And well, that sounds like a pretty good position to be in, and certainly it is, right? But really at that point, it comes down to risk allocation, right? Um, uh, I'm currently working with a company in the metal building products space. So they help build metal buildings. They do the manufacturing, the steel, and it's a great business. And when we first started talking to this founder, he said he didn't want to sell for several years. And we asked why. Well, okay, why is that? Well, he wanted the business to be worth $200 million. Okay. Um, okay, that's great. Why? Um, I don't know. Sounds like a good number to tell my friends at the country club. Sounds pretty good at a cocktail party, right? Okay, well, the business is probably worth between 110 and 130 today. So the path to 200 million, these are the things that you're gonna have to do over several years. But Mr. Seller, why don't you at least have you talked or worked with a financial advisor, someone on the estate planning side? And we recommended that, and he really hadn't. He hadn't done any of that work. And so he went away, worked with an advisor that we knew to do a full workup on his financial situation. And what the advisor found is consistent with what we see a lot of times, right? 95% of his family's wealth was tied up in this business, right? And he had aging parents that were going to need care. His kids are starting to enter college. And so as he was thinking about working with this advisor to understand what are all the things I want to do with the money, right? Okay, I want a great mountain house. I want to help my parents retire. I want to give the good kids a good foundation, and I want to give a bunch of money to charity. Okay. So after he had listed all those things and the money he would want to be able to allocate to those things, he still had way more money in the business than he was actually ever going to need, right? And so at that point, it was really about risk allocation and realizing, man, I'm in this industry, this construction industry, right, that can be pretty volatile. And tomorrow's never guaranteed in that industry, right? In terms of how the real estate market is going to go with new buildings, right? And so the long story short is he ended up deciding to move forward sooner, even though he wasn't near his $200 million number, to protect the wealth he had created, because it simply wasn't worth the risk to keep all the eggs in that basket. We also discussed this framework in session one. We talked about scalability and transferability of value as two internal key drivers in determining the enterprise value of your business. And again, enterprise value is just a fancy word for how much the business is worth. We discussed the scalability attributes in that first session, but we really didn't get to transferability of value. So transferability is largely impacted by your personal timeline in significant ways. If you're an active operator in your business, the vast majority of buyers will want you to stay on post-close for an extended period of time. Some may only want a transition period, but many will actually want to invest in you as the founder and entrepreneur to continue to lead the business. And if your transition timeline is shorter than the buyer desires, it will negatively impact that enterprise value. So really, Whereas scalability is the growth side of the equation, transferability is, from an investor's perspective, is the risk side of the equation. And so what are some of the areas where there's transferability risk from a buyer's perspective when you're investing in a family-owned business, right? Well, it's things like, what kind of exec team does this business have beyond the ownership group? How will the transition of that business impact the customers, the employees, and the suppliers? Are there relational dependencies held with that owner? Are there contracts that govern key business relationships, or is it really just a bunch of handshake deals, right? Is there an instruction manual, or are there instruction manuals really that will create a smooth operational transition? Does the company use technology to automate key aspects of their infrastructure, right? And so, we've got great surveys. There are great surveys out there that you can do some of this work to just kind of look at that transferability risk, right? And so you want to be honest with yourself in regards to those questions, and actually step back and look at your business through the lens of a buyer and through their eyes. Where would you see transition risk, and where would it cause you to actually be maybe more conservative in your valuation, and more likely to actually want the seller to stay on and be involved for a significant period of time? Next, Jason mentioned at the outset the 2-bite exit. And I want to talk about this in some detail, because it's often something that sellers don't really think about. It's a way that many private equity investors overcome transition risk, is actually by asking the sellers to roll equity in the deal into a second bite. Okay, so if you want to maximize total liquidity and total value to the seller, it's often done in actually a 2-step exit. So again, as Jason said at the outset, exit is a very binary word in our minds, right? I'm either in or I'm out. But the reality is that in reality, the word exit in the context of selling a business is not really binary. That's a misconception. In the case of a business sale, the exit is often more like the ebb of the tides, right? It's gradually happening, and the tide is receding right into the ocean, and that happens gradually. So to restate the obvious, this means that if maximizing liquidity is often done in 2 steps, that means that the business value is not maximized through a one and done deal, oftentimes. So one and done, meaning like I'm selling and I'm out. Those are oftentimes at a lower valuation. They contain more contingent consideration via earnouts that are based on post-close performance. So what exactly do I mean by a 2-bite exit? Well, it means that it's going to really be a majority recapitalization as the first step. The seller is going to continue to own a significant minority stake in the business, and oftentimes retain a significant operational role, ROLE, right? You're going to roll ROLL equity, and you're going to have an operational role, ROLE, in the business as well, depending on how involved you were prior to the close. The original investor usually looks for the seller to retain 10 to 40%. And the second bite occurs. That is when the original buyer sells to the next buyer. That usually happens over a 3 to 5 year type time horizon. And so why do investors often pay a premium valuation in this sort of 2-bite scenario? Well, one is it demonstrates that the seller still has conviction in the business and its long-term growth potential, right? They still have quote unquote skin in the game, right? And it gives those investors lots of comfort that you know you're not just selling because you realize that there's some sort of headwind that's coming into the industry, and you're trying to get good and leave them with the bag, if you will. And so the next thing is really about the seller's increased risk tolerance in growing the business. So when private equity buys a business, they're usually looking to grow faster than the founder entrepreneur was, and even strategic buyers. But they're willing to use capital and other things to accelerate attractive step change growth opportunities. And oftentimes the entrepreneur that is recapitalizing has great ideas that they've thought about executing against, but they just haven't, because they don't want to double down on their investment and put more chips in, right, as they're approaching their exit, right? So from a psychological standpoint, if the entrepreneur is able to actually take some of those chips off of the table in a recapitalization, then the entrepreneur is mentally freed up to pursue those growth opportunities of scale, right? And to work with the buyer in really more of a partnership mentality to grow the business into the next level over that 3 to 5 years. So we were representing a business that manufactured key lime pie, and we're going to talk about this maybe a little bit more at the end. But the business was regionally focused in the Southeast, selling key lime pie to grocery stores like Kroger. In order to go more national, they would need to open an additional facility. But the owner was just age-wise getting up there in age, was really just unwilling to make that bet on his own when 90+% of his net worth was tied up in the business. And so by selling a significant stake and bringing on a partner with deeper pockets behind him, then that enabled the owner to really be aggressive with those expansion plans, right? Because now he's using someone else's money in combination with some of the equity he left in, right? But his risk allocation and risk appetite has changed. Lastly, I'll say that the reason that a buyer loves the owner and entrepreneur to do this second bite approach is it creates less risk that the team underneath the entrepreneur is going to leave, right? Investors realize that much of the intangible value they're acquiring is the assembled workforce of the business, and keeping it intact is paramount to continuing to build business value. And so I think the historical reputation overall for private equity, right, is having, this reputation of, we're going to come in and we're going to, just strip things to the bone, and we're going to cut cost in order to increase margin. And, we're the smartest guys in the room. And so however you've been running your business, we can run it better than you, right? And I would say, that mentality has really shifted over the last decade, right? Investors have been burned when they've sort of tried to come in and change the logo and rebrand everything, right? So what we're seeing is that more and more, most smart private equity firms have sort of abandoned the hubris of, hey, I can run this better than you. And they've changed their mindset to, hey, let's partner with the entrepreneur. Let's not do any harm here. let's grow this together because whatever they're doing seems to be working, and that's why we built the business in the first place. So instead of just, bringing in a new coaching staff and a new playbook, right? It's like, hey, let's use the entrepreneur's playbook. Let's not abandon it, but let's augment it and enhance it. So I want to look at how this played out from a transferability of value perspective with two businesses in the janitorial space. These are two actual businesses that I worked with, changed the names to protect the innocent, and I am hopefully going to take a little poll here, and this is where your participation comes in. So be ready. All right. So the first business I'm going to call Alabaster. So it's got a founder in the mid 60s, business 3 million EBITDA, facility maintenance, janitorial services, 100% owned by this founder. His objective is, look, I want to sell this. I'm gonna transition after a year. I want to get my cash out and retire. He also had a daughter in the business. She had started her career in financial services, but she was helicoptered into the business to help with the day-to-day operations after, tragically, her brother who had been in the business passed away. But she's recently married and she wants to focus on starting a family, so she's not interested in sticking around either. Okay. The business does have a good operations manager, but no clear replacement for that. But no clear replacement for the founder who led sales or the daughter who led finance and administration. So post close, the buyer's going to need to bring in a new CEO and COO or CFO. The second business we're going to call Bolton. Again, founder in the mid 60s, hasn't been involved in the business in a long time. He actually hired a young professional CEO to run the business. The CEO has actually helped them already acquire a couple really small players, and those were very successful acquisitions. Same size business, same industry, almost the exact same service profile. Post-close, the existing CEO, the young professional, is actually excited to stay with the business. He has some equity. He's going to continue to reinvest. And he's excited to grow the business into new geographies. And there's a very clear growth strategy. All right. The founder believes in the future of this business, and he's excited to roll 20% and keep skin in the game. So here's where my poll comes in. I want you guys to answer the question. Do you think the valuation multiple, the EBITDA multiple, was higher, lower, or the same as Alabaster? The valuation multiple on Alabaster was 5.25. So was the valuation multiple higher, lower, or the same? And then I want you to take a stab. What do you think? What do you think the multiple was? I'm just curious. Putting you on the spot. Jason's got a 6.825. Very specific. No, it's 6.829. Just kidding, Jason. Okay, Leon's got higher, around 8 to 10. Good. Anyone else? Higher, 7. Good. Good. You guys are good students here. All right. You're getting it up. Perfect. Well, the multiple was actually a 7.5. All right. So that is actually a 43% premium over Alabaster, right? And the interesting thing about this, when you do the math, in scenario 2, the owner of Bolton actually got more cash in the initial deal with just 80% out than did the owner of Alabaster for his 100%. So the 20% rolled equity was in some ways kind of free, because the situation was so much more favorable for the buyer. So I want to actually do a little bit of a math exercise. You guys didn't know you're going to be in math class today, but we're going to walk through the actual details of a second bite here. So in scenario 1, we've got a one-time exit. In scenario 2, we've got a two-step. All right. So the transaction type in scenario 1, we're going to call 100% sale, 75% recap. In scenario 2, where the owner operator is partnering with the investor. Same EBITDA. In this case, we're going to say that the multiple is actually only 1 times higher. So I'm being conservative in scenario 2 that the multiple is only 1 turn higher from 6 to 7. Even though in the last example it was significantly a higher premium than that. And so that creates an initial enterprise value. All right. In scenario 1, we're not rolling any equity, right? So that's NA, that's 0. And then the 25% is roughly 5.8 million. All right. The owner reinvests and he's on board to run the company for another 3 to 5 years. So initial cash, scenario 1, 20 million, a little bit lower in scenario 2 because you're getting that rolled equity. And then really what matters is, okay, what does that rolled equity turn into, right? And so if you talk to any folks that invest in privately held businesses, really what they want to see is sort of a solid double, right? From a baseball analogy, is they want to see a 3x return, cash on cash return on the money that they've invested, and hopefully more like a 4 or a 5x on that initial cash investment, right? And so if you're rolling equity beside them, that's what you would have those same economics. So the expectation is that somewhere between 3 and 5x cash on cash return to whatever equity is in the deal. And so just using a 3.5x on the 5.8 million of reinvestment, now that second bite is worth 20 million, which was more than the 20% ended up being worth more than the initial cash out because because of the change in growth trajectory in the business. And now that means the total cash out in scenario 2 is 37.5. So really what I want you guys to take away from this as you're thinking about the timing of your exit is this: if you want to be all the way out, if you want all the ownership to be gone in 3 to 5 years, you may want to strongly consider doing an initial recapitalization now, and partnering with private equity, right? As opposed to waiting that additional 3 to 5 years and just continuing to run the business, and then selling all at once when you're ready to retire. So that 2 bite really works best if you've got that 3 to 5 year runway and you do it 3 to 5 years ahead of when you want that second bite and the full redemption of your equity. So Jason, as far as time, I've got another section, but it seems like we're approaching that 9 o'clock. What do you want to do?
I think this is fantastic content. So maybe another 5 to 8 minutes.
Great. All right, so we're going to do one more section. We're going to fly through here. We're gonna switch it up here. And so one thing I know is the case, as I mentioned at the outset, is one of the reasons that sellers entertain selling is actually because the buyer comes to them, right? And one thing that can disrupt the carefully timed exit of an entrepreneur is getting an unsolicited offer from a buyer, right? And that's happening more and more every day because investors are looking to deal directly with entrepreneurs as opposed to going through advisors. And why are they doing that? It's pretty simple. The market is super competitive, and they're more likely to win the deal if they do it directly with an entrepreneur. And they're also almost always going to get better economics and terms by going direct. So if an investor is reaching out to you directly and you're intrigued by their offer, how do you begin to evaluate next steps? Okay. So first is just, if it's not on your timing, right? If this isn't fortuitous, you weren't thinking about it, really make sure that you're clear with yourself why you're even engaging, right? Are you just flattered? Are you starting to feel tired? Are you just curious, right? What is it? What type of buyer group is this, right? But make sure you have clarity as to why you're engaging. And having conversations with investors that are interested in buying your business is by no means a bad idea, right? Even if you're not interested in selling, but make sure you understand why you're engaging. Oftentimes it's a great idea to gain intelligence on your industry and on, what this particular buyer, particularly if it's a strategic buyer, what do they care about? What kinds of questions are they asking you in evaluating your business? If it's a strategic buyer, you might be able to get some inside intelligence on the size and positioning of them in the market. But just be very careful about sharing your own confidential information with a buyer if you're only really lukewarm about selling. Just be cautious. The reality is that most buyers that approach you directly, they want to put the cart before the horse. They're going to propose to you after the first date. They're going to come to you with an engagement ring to lock you up, right? Take you off the market. And then they're going to actually decide if they actually want to marry you, right? Then they're going to decide, if they want to spend all the money on the wedding. All right. So with those cautions aside, how do you begin to evaluate their offer? We talk about the 3 C's at SDR: the consideration, the certainty of close, and closure as the pillars to evaluating any offer. Okay. So the consideration, that's the most obvious, right? And people oftentimes they only think about that headline number. And so if you get an unsolicited offer, do you have a framework for knowing what a reasonable valuation is? Have you had a recent independent valuation, right? Do you know what else is happening in your industry, what transactions are going on, what the multiples have been? That being said, after the headline number, I actually say that the structure of the economics is just as important as the headline number, right? So buyers are often going to tout a reasonable headline number, but with really, really significant structure that's not market. So I just talked to a seller who said, he was in an industry, and I said, okay, well, what was the offer? Well, I got an offer at about 6 times EBITDA, right? Okay, that sounds reasonable for this industry. It's not great, but it's probably within range. But I probed a little bit further, right? And it turned out that on that on that valuation, only 40% of the deal was going to be in cash. And that he was going to have it was going to take 10 years to get the rest of the money out. And that's, never in a million years, right, would I recommend that deal to a seller, right? So you just got to be really careful about the structure and understanding. Less than 10% of deals are straight cash deals. You want to expect some structure, but you need to evaluate, whether it's reasonable. The other reality is you've got hidden economics in a deal that aren't transparent oftentimes at the beginning, right? You need to understand how much net working capital the buyer's expecting to be in the business. Make sure it's is it a cash-free, debt-free deal? Is there a holdback? There usually is a holdback that the buyer takes around reps and warranties in the purchase agreement as insurance that the business is as you presented it. So, and then also, like, if you're continuing in any role in the business, what are your economics from now if you're an employee, what's your comp, right? Post-close. So those are all sort of hidden economics in a deal that you want to be aware of. Next is the certainty of close. Again, only studies indicate only 20 to 30% of deals end up closing business transactions. So we are fond of saying nothing good happens to the seller after a signed letter of intent. So the letter of intent, which is the framework, the kind of the non-binding offer, just be cautious that don't be too naive to think that the buyer always intends to close on the deals that they set forth in that letter of intent. You got to understand where is the buyer getting the funding for this deal, right? How many deals have they done in your industry, right? What you're trying to evaluate is not just can they close a deal, but can they close the deal that was put forth in the LOI, right? So that's certainty of close. And then lastly is closure. What does your next chapter look like? And if you're working with a buyer on an unsolicited basis, you really don't have options. You don't know, you have whatever they want as that option, right? And does it align with your plans? I talked about the key lime pie company. So Kenny Burks was the founder of Kenny's Key Lime Pies. We had, for Kenny's business, we had 3 different buyers at the table. We had Sarah Lee. We had a private equity group that had a portfolio of dessert brands. And we had a family office that was interested in the dessert space. A family office is like a very wealthy family that likes to invest in businesses. And so Sarah Lee came out strongest on the economics. They were going to pay Kenny the most by far. But, as we dug in, right, it turned out that, Kenny's in Atlanta. He's a pillar of the community. Okay, well, we're going to keep the manufacturing in Atlanta, right? Well, actually, that's not where our operations are. He's got a son-in-law running the business. Okay, so what happens to management team? Well, maybe we don't really need all those folks, right? Well, surely you're going to promote the Kenny's brand, right? Well, actually, now it's probably going to be, Sarah Lee's Key Lime Pies, right? And so none of those things really fit in, with Kenny's framework. And so, the family office, right? Initially they were down here on the economics. Sarah Lee was up here. We were eventually able to get him to about here. We never got him all the way, right? But we were able to raise him up, and Kenny was so much more happy to go with that family office, to leave the manufacturing where it was. The family office was like, hey, we're not trying to change Kenny's at all. In fact, what we want to do is take you from a regional brand to a national brand. We're going to support that facility expansion, et cetera, et cetera.